Hello everyone, welcome to EduTap and welcome to Finance 360-degree session. So today we are going to discuss two articles and we are going to discuss the two very important notifications of the Reserve Bank of India. Okay, so these both notifications, they are very important from the RBI Grade B perspective. So first of all, I hope I'm clearly audible and the screen is visible to all of you. So welcome to the session everyone and welcome to the Finance 360-degree session. So today we are going to discuss the notifications of the RBI regarding the first notification is regarding the addition of the quarterly profits in the common equity tier 1 capital. So we will discuss that how this will be added and what is common equity tier 1 capital, what are the important percentages that you have to remember from the examination perspective. The second news article we will discuss about the asset classification. Okay, the second news article we will discuss about the asset classification. So these are the two news articles that we have to discuss, or the two notifications that we have to discuss. The first one is regarding the RBI Commercial Banks Prudential Norms on Capital Adequacy, Fifth Amendment Directions 2026. So the three notifications are released by the Reserve Bank of India. One is for the commercial banks, the other one is for the small finance bank, and the other one is for the payment bank. All of these notifications you will be easily able to understand if you understood these 2 points that we have to discuss. Okay, so first of all, see, the RBI mandates and there is the minimum regulatory requirement, there is the minimum regulatory requirement that the commercial banks, they have to maintain the CRAR is the capital adequacy ratio. So the banks, the commercial banks, they have to maintain the minimum adequate capital of what percentage? Anyone remembers? What is the minimum percentage of the capital adequacy ratio, the adequate capital that the banks have to maintain? It is 9%. So CRAR requirement is 9%, out of which there is two kinds of capital. So capital is divided into tier 1 capital and the tier 2 capital. Okay? Tier 1 capital is the most liquid capital. It is the most liquid capital, or the liquid capital that the banks have, that the banks can use in case of any concern, in case of any distress, the bank can use the tier 1 capital. Under the tier 1 capital, there is common equity tier 1 capital and additional tier 1 capital. Okay? So common equity tier 1 capital is the most liquid capital that the bank can use in case of distress. Okay, so this is the idea that the banks have mandated the commercial banks, the RBI has mandated the commercial banks to maintain the minimum CRAR of 9%, out of which, like, the capital is maintained in the tier 1 capital form and tier 2 capital form. Tier 1 is liquid capital, that includes common equity tier 1 and additional tier 1 capital. Now the tier 1, what is the percentage of the tier 1 capital that the banks have to maintain? So the capital that the banks have to maintain, in the capital, there is tier 1 capital and there is tier 2 capital. Okay, there is tier 1 capital and there is tier 2 capital. So what is the percentage? So if the banks have to maintain the capital of 9% against the risk weighted assets, against the risky assets, the banks have to maintain the capital of 9%. So what is the tier 1 capital the banks have to maintain? The tier 1 capital that the banks have to maintain is 7%. And under the tier 1 capital, there is common equity tier 1 capital and additional tier 1 capital. So common equity tier 1 capital that the banks have to maintain is 5.5%. Okay, so this is the common equity tier 1 capital that the commercial banks have to maintain. Now here it has been said that the RBI had issued the Reserve Bank of India Commercial Banks Prudential Norms on Capital Adequacy against the risk weighted assets, against the risky assets that the banks are providing. Okay, against the risky loans, or the loans that have the risk. Okay, the loans have the risk. So the banks are providing the risky loans, or the banks are providing the loans that have some risk. So against the risk weighted loans, against the risk weighted asset, the banks have to maintain the capital. Okay, commercial banks have to maintain the capital of 9% against the risk weighted asset, in which the tier 1 capital, that is the liquid capital, has to be maintained 7%, out of which common equity tier 1 capital should be 5.5%. This is the basic idea. Now, recently the RBI has amended the guidelines and it is proposed to amend the provision relating to inclusion of quarterly profits. So basically, the quarterly profits will be included in the common equity tier 1 capital. Till now, what is included in the common equity tier 1 capital? So we include the paid up equity share. Paid up equity share basically means that the money that the shareholders have provided to the company. So the money that is invested by the shareholders in the shares, this money is going to the company, and this is the liquid capital with the company. Okay? Other than this, share premium. There are certain shares that are sold at a higher valuation. So whatever is the additional value that is coming by selling the shares, that goes to the share premium. Then there is the retained earnings. Retained earnings is basically the balance in the loss and profit account at the end of the financial year. So at the end of the financial year, whatever is the retained earning. See, let's say the profit has been earned by the company. From this profit, the bank has to pay the tax. After the tax has been paid, what is left with the bank? Profit after tax. Now, from this profit after tax, that is also known as the net profit. From the profit after tax, the bank has to pay the dividend to the shareholders. Dividend has to be paid to the shareholders. Now, whatever is the dividend, let's say the profit was 100 rupees and the tax has been paid. So from the profit, the tax has been paid, that is 10 rupees. So now what is left with the bank? 90 rupees is left. This is profit after tax, or the net profit that is left with the bank, 90 rupees. From this, let's say the dividend is paid. The dividend is paid, that is 50 rupees. Now the bank is left with how much? The bank is left with 40 rupees, right? This is known as the retained earnings, that is retained by the bank for its own functions in the future, for its own operations, or for its expansions. For its expansion, the bank is keeping the retained earning, or the company is keeping the retained earnings. This is the basic idea, that from the profit after tax, from the net profits, the dividend has to be paid out to the shareholders, because shareholders have invested in the shares. So the dividend has to be paid. The part of the profit has to be paid to the shareholders, and whatever is left, that is retained earnings, or the undistributed profits. So these are the liquid, like the funds that the bank has or the company has. So the retained earnings also come under the most liquid capital, that is the common equity tier 1 capital. So retained earnings were added for the financial year. At the end of the financial year, the retained earnings, whatever is the part of the profit that is left with the bank, that is added in the common equity tier 1 capital. It was known as the balance in the profit and loss account at the end of the financial year. So whatever is the balance is left in the profit and loss account, that was added in the common equity tier 1 capital. Okay? Now, what has been said? What is the update that has happened that we have to discuss? So a bank may reckon the profits in the current financial year, that we have discussed, that the profits or the balance in the profit account, the balance that is left in the profit account after paying the dividends, after paying the tax, whatever is the balance that is in the profit account at the end of the financial year, that was added in the CRAR, that was added in the common equity tier 1 capital under the CRAR. Now it has been said that rather than just adding the the profits or the retained earnings at the end of the financial year, you can also add, the RBI has allowed that the banks can also add the profit on the quarterly basis, or the retained earnings on the quarterly basis in the common equity tier 1 capital. This is the update that has happened. Okay, let me just open the additional document. Just a second. So any confusion till now, anyone? No. First, dividend has to be paid out. Okay, dividend is announced. First, the shareholders. See, from the profits, tax has to be paid. Okay, from the profit, tax has to be paid. From the profit after tax, Acha, statistician, you have a question? Okay. So from the profit after tax, if there is a profit after tax, let's say of 90 rupees. Now, if the banks think that yes, they can announce the dividend, they announce the dividend, okay? So they announce the dividend of 50 rupees, let's say. There is some rules and regulations. I hope you have, like in the March, we discussed the rules for the announcement of dividend by the banks. The banks can announce the dividend only when they have positive adjusted profit after tax. So we have discussed that already in a previous session, that what are the rules regarding the announcement of the dividend, okay? So if the bank has the positive profit after tax, then the bank announces the dividend. Here we are just taking a very generic understanding so that the things are not very complicated. Otherwise, we have already discussed in a previous session that the dividend is announced by the banks on the basis of the adjusted profit after tax, okay? Now, so from what we were discussing was that from the profit after tax, this is the net profit. This is the net profit. So if the bank is earning the profit, the bank wants to pay to its shareholders also. So bank is paying the dividend. And whatever is left basically means that after paying the dividend, whatever is left is the retained earnings. Okay? So from the profit after tax, basically the bank is paying the dividend and the bank is keeping the retained earnings. Let's say dividend is rupees 50, retained earnings is rupees 40, because the bank wants to pay good to its shareholders to show the other investors in the market to invest in the bank. Okay, so bank always wants to pay to its shareholders in a good amount so that the other investors are also attracted towards the bank, or the bank can raise funds in the future. So this is the idea. So the bank is giving the dividend and whatever is left is the retained earning. Now retained earnings were added in the CRAR, in the capital against the risk weighted asset, in the capital against the risk weighted asset under the capital. The bank was keeping the retained earnings under the common equity tier 1 capital. The retained earnings were added at the end of the financial year. Now basically the RBI has said that even the quarterly retained earnings or the quarterly profit can be added in the common equity tier 1 capital. That is the update that has happened. And in what way this will be done, so that we have to discuss. So a bank may reckon the profits in the current financial year for CRAR calculation on a quarterly basis. So basically from the profits, the retained earnings can be added in the CRAR under the common equity tier 1 capital on the quarterly basis. But for the quarterly basis, there is a certain formula that has been provided, that what is the eligible profit? What is the eligible profit? Can we add the whole quarterly profit under the common equity tier 1 capital? Can the whole quarterly profit, can it whole be added under the common equity tier 1 capital? Can the full amount of the quarterly profit, can it be added in the common equity tier 1 capital? What do you think? No. From the quarterly profit, first we have to pay the tax. Or the bank has to pay the tax first. So that means the eligible profit of the quarter that can be added in the common equity tier 1 capital, it comes from the net profit. From the net profit of the quarter, not the whole profit, not the whole quarterly profit. No, from the quarterly profit, tax has to be paid. So after paying the tax or after deducting the tax amount that has to be paid, so net profit of the quarter, we come to the net profit of the quarter. Can the whole net profit be given, can be kept in the common equity tier 1 capital? Can the whole net profit, generally what happens that the whole of the net profit or whole of the profit after tax, can we keep it under the common equity tier 1 capital as the retained earnings? No, some dividend has to be paid out, right? Some dividend has to be paid out. Now here we have the quarterly net profit. So actually it has been said that how can we say the quarterly dividend? So instead of seeing the quarterly dividend, we take the dividend in the past 3 years. We take the average of the dividend in the past 3 years. So we take the average of the dividend in the past 3 years. So average of the dividend in the past 3 years. Now this is the data for the yearly. How are we comparing the yearly data with the quarterly data? So for this, we have to multiply the average dividend in the past 3 years with 0.25, because in 1 year there are 4 quarters. That means in 1 year there are 4 quarters. That means 0.25 we can multiply the average dividend in the past 3 years to come to the quarterly dividend. Okay, so basically the eligible profit that can be added, in the common equity tier 1 capital is the retained earnings. Okay, eligible profit in the quarter that can be added in the common equity tier 1 as the retained earnings is equal to the net profit of the quarter deducting the average dividend of past 3 years. Now this is the yearly data, so we multiply it with the 0.25 to come to the quarterly data. Okay, so this is the formula for adding. Now whatever is left is the retained earnings that the bank can show in its common equity tier 1 capital. So net profits, that means the tax has been paid, so this is the profit after tax of the quarter, and from this deduct the dividend, average dividend of the past 3 years, and we convert it in the quarterly dividend basically by multiplying it with the fraction, that is 0.25. Okay, so we have deducted the dividend, and now from the profit after tax of the quarter we have deducted the dividend, the average dividend and such, and we come to the retained earnings, that is the eligible profit of the quarter that can be added in the common equity tier 1. Chalo, any confusion here? So the financial statement, see, the amount which can be reckoned shall be arrived at by using the following formula. The eligible profit of the quarter is equal to the net profit. The eligible profit of the quarter that can be added in the common equity tier 1 is equal to the net profit of the quarter minus the 0.25, that is for the average dividend. That is the dividend of the quarter. Okay, so here we take the average dividend of the past 3 years and multiply it with the 0.25. This is the idea. So here D is the dividend, average dividend paid during the last 3 financial years, and we multiply it with the 0.25 to come to the quarterly data. Any confusion? This is it. This is the idea. So the idea is that under the CRAR, there is the tier 1 capital. Under this, there is common equity tier 1 capital. That is the most liquid capital that the bank has, to maintain 5.5%. Okay, against the risk-weighted assets. Now, under the common equity tier 1 capital, the retained earnings were added for the financial year, at the end of the financial year. Now, the RBI has said that even the quarterly profit can be added under the CRAR, under the common equity tier 1 capital. But which quarterly profit? Can the whole quarterly profit be added in the under the CRAR, under the common equity tier 1 capital? No. There is the eligible profit of the quarter that can be added. So eligible profit of the quarter is basically the net profit in the quarter, that is the profit after tax of the quarter, deducting the average dividend that is paid in the last 3 financial years, okay, and we have taken the average dividend because how much dividend will be paid out for the whole year, it is not known at the start only. So we are taking the average dividend in the last 3 years, and we are multiplying it with 0.25 to come to the quarterly data. So basically from the net profit, from the profit after tax of the quarter, we have deducted the average dividend for the quarter. Average dividend in the last 3 financial year, multiplying it with the 0.25 to show the average dividend for the quarter. So we have deducted the average dividend for the quarter, and that's why we have come to the eligible profit of the quarter that can be added under the common equity tier 1 capital as the retained earnings for the quarter. Any confusion now? Okay. So this is the whole idea, that from the profit after tax, the dividend is paid, and whatever is left is the retained earnings. So dividend from the profit after tax, dividend has been deducted, and whatever is left will go as the retained earning for the quarter. The cumulative net loss up to the quarter end shall be fully deducted while calculating common equity tier 1 capital for the relevant quarter. So cumulative net loss has to be deducted from the common equity tier 1 capital. That is the basic idea. So Reserve Bank of India has also released the Small Finance Banks Prudential Norms on Capital Adequacy 4th Amendment Directions 2026. Basically the same thing has been said, that see, in the small finance banks, Against the risk-weighted assets, small finance banks are providing the loans that are the asset for the bank because the bank is earning interest on these loans, but the loans have some risk weight. So against the risk-weighted assets, against the risky loans, against the risky assets, the bank has to maintain capital. Small finance banks have to maintain the capital of what percentage? 15%. Under this, there is tier 1 capital, tier 2 capital. Tier 1 capital is a minimum of 7.5%. Okay? And under the tier 1 capital, there is common equity tier 1 capital, that is the minimum of 6%. So this is the idea. Now in the common equity tier 1 capital, the retained earnings were added for the financial year. At the end of the financial year, the retained earnings were added. At the end of the financial year, the retained earnings were added. Okay? Under the common equity tier 1 capital, this is the retained earnings of the firm. This is the liquid capital, the liquid money that the firm has, that the bank has. Now, what the RBI has said, that a bank can reckon or add the profits in the current financial year for the CRAR calculation on a quarterly basis. On the quarterly basis, the retained earnings can be added. The retained earnings can be added on the quarterly basis. That means eligible profits can be added on the quarterly basis. Under the common equity tier 1 capital, what is the formula? So eligible profit that can be added on the quarterly basis is equal to the net profit on the quarterly basis minus the average dividend of the past how many years? The average dividend of past how many years? The average dividend of past 3 years. Average dividend of past 3 years. Now if we are seeing the yearly data, we do not want to see it. We want to see the yearly data in the quarterly form. So we multiply it with 0.25 because there are 4 quarters. So 0.25 is for 1 quarter. Okay? So average dividend of past 3 years, the average dividend paid during the last 3 financial years. So we multiply it with 0.25 to get to the dividend, average dividend for the quarter basically. So net profits, from the profit after tax of the quarter, we have deducted the dividends for the quarter basically. We have deducted 0.25 multiplied by the average dividend of the past 3 years. So that is the dividend of the quarter we can say. And we come to the eligible profit for the quarter. That is the retained earnings that can be added in the common equity tier 1 capital. The same thing will continue for the payments bank also. That the same formula, the eligible profit of the quarter is the net profit of the quarter, the profit after tax of the quarter minus 0.25 multiplied by the average dividend that is paid for the past 3 years. That is, we have deducted the dividend, the quarterly dividend. So from the profit after tax, if we have deducted the dividend, then what is left? The retained earnings for the quarter, that is the eligible profit for the quarter, that can be added in the common equity tier 1 capital. I hope there is no confusion that is here now. Okay? For the commercial bank, small finance bank, and for the payment bank, the same norm has been added. The same norm has been added. Now, coming to the next article, that is regarding the asset classification. Okay? So, Reserve Bank of India Commercial Banks Asset Classification, Provisioning and Income Recognition Directions 2026. So today we are going to focus on the asset classification. And in the next session, we are going to focus on the income recognition and such. Okay. So right now, first let's start with the asset classification. So the RBI has repealed Commercial Banks Income Recognition, Asset Classification and Provisioning Directions 2025. So RBI has repealed the earlier directions and the new directions have been introduced. So RBI has now brought a new commercial bank asset classification, provisioning, income recognition directions 2026. So the new directions have been brought after repealing the previous directions. Okay. Now the new directions will be applicable from the next financial year, so that we will discuss. So the new directions mainly bring 3 important changes. So the 3 important changes have been brought under the new directions. There is the introduction of the staging system under the expected credit loss approach. So introduction of a staging system. There is stage 1, stage 2, stage 3. This kind of staging system has been introduced under the expected credit loss approach. What is the expected credit loss approach, incurred credit loss approach? All of this we will discuss. But the idea is that there is the introduction of a staging system under the expected credit loss approach. However, the old rules for identifying NPAs will still continue. The 90-day criteria will still continue. Introduction of forward-looking provisioning system. So there is the introduction of the forward-looking provisioning system, that before the loss finally happens, before that only the provisions should be started to be maintained. Okay, so before the actual loss happens, on the preemptive basis, the bank should start maintaining the provisions. Why, how this will happen, this we will discuss. So there is the introduction of forward looking provisioning system. Also there is the use of effective interest rate method to calculate interest income and the value of loans. Okay, so how this effective interest rate will be used, that we will discuss. But these are the three main changes that we have to discuss. The staging system under the expected credit loss approach, there is the introduction of forward looking provisioning system, use of effective interest rate method. These directions shall come into force with effect from April 1, 2027. As I told you that these directions, they are applicable from the next financial year, from April 1, 2027, from the next financial year. Applicability is for the commercial banks, excluding small finance bank, payment bank and local area bank. So the applicability is for the commercial banks, corresponding new banks and the State Bank of India, excluding the small finance bank, payment bank and local area bank. Now, classification of NPA. So it has been said that the old rules for identifying the NPA will still continue, but in the direction, all the NPA rules have been laid down. So yes, a question can come from this also. That's why we have brought it in this table format, so that in a fast manner we can understand the classification as NPA. So which loans or at what time the loans are classified as NPA or the assets are classified as NPA, non-performing asset. First of all, you have to understand that the loans, if a bank is providing the loan, is this the asset of the bank? Yes or no? If a bank is providing the loan and the bank is earning interest on this, this is the asset for the bank, because the bank is earning the returns on this money. But the loans, they have risk. That is why we talked about the risk weighted assets. That's why we talked about the risk weighted asset. The loans have the risk attached. Okay, as well as, let's say the bank is purchasing a debt instrument of a company. That means the bank has given the debt to the company. The bank has purchased the corporate bond, that is a debt instrument through which the corporate is taking the loan basically. So bank has invested in the debt instrument. That means the bank is, through the financial market, the bank is giving the loan to the corporate entity. This also, now this debt instrument also has some risk weight. So if the bank is giving the loan directly, if the bank is giving the loan, or if the bank is investing in the debt instruments, or let's say the bank is giving the overdraft facility, that is the till the sanctioned limit, you can take out more funds from your account. In your current account, there is a sanctioned limit of 2 lakh. That means even if you have 10,000 in your account, you can take out the money till the limit of 2 lakh. So that is a basic loan that is given to you. The credit card, you do not have money in the bank account, still you are able to purchase some things through the credit card. So that is a kind of loan that is given. There is also the trade receivables that is purchased by the bank. Trade receivables basically, or the receivables are basically where the bank is giving the money to the seller in the current period at the discounted rate, saying that the bank will get the money from the buyer. Okay, so the buyer purchased the products from the seller worth 10 crore. Now the buyer is saying that I will be able to pay after 2 months. Seller need the money immediately. Seller will go to the bank. Bank will give the immediate funds to the seller at a discounted rate. Maybe the bank is only giving 9.8 crore. Okay, buyer will pay after 2 months to the bank, and bank will get 10 crores. That is 20 lakhs is the profit for the bank in this case. So this is the idea. These are the, like the seller gives the invoices or the bills or the trade receivables to the bank, and the bill goes to the bank can take the money from the buyer. Okay, and the seller gets the immediate funds, buyer can pay after 2 months, and the bank will get a profit for getting the money from the buyer after 2 months. So this is the trade receivables. This is also the asset that the bank invests in, because here also the bank is earning some returns. Here also bank is earning some returns. So all of this is what? is the asset for the bank. Even the loan, the debt instruments that the bank has purchased, the overdraft facility, the credit cards, these are the asset for the bank. But all of these have some risk attached. Even the trade receivables. What if the buyer do not pay after 2 months? The bank has paid to the seller. The bank has paid to the seller 9.8 crore. What if the buyer does not pay after 2 months or pays only 5 crore rupees or the partial amount? So bank will be making the loss. Okay? So this is the idea that in all these cases, like the loans that are given, the bills that are purchased or the bills that are discounted for the seller, the bonds and the debentures that are the debt instruments, in all these cases, they can be classified as NPA if the interest, if on the loan, the interest is not paid, if on the loan the principal amounts are not being paid, the installments are not being paid, the EMIs are not being paid, or maturity proceeds in the case of the bill discounted, or in case of the bonds, debentures, the maturity proceeds remain unpaid for more than 90 days, then this will be classified. Then the term loans, bills, discounted bonds and debentures, they will be termed as NPA. Okay? So if the bill had to be cleared after 2 months and the bill is not getting cleared after 2 months, that means after 90 days now from the date of outstanding, for 90 days the bank will wait, and after 90 days the bank will consider it as NPA. If the loan interest is not coming, the EMIs are not coming, the installments are not coming basically, so bank will consider it NPA after 90 days. If in the debt instrument the interest is not coming, the maturity proceeds are not coming, so bank will consider it NPA after 90 days. That is the idea, right? That is the idea. So term loans, bills purchased, discounted, bonds, debentures, if the amount is unpaid for more than 90 days, then this will be classified as NPA. Overdraft or cash credit accounts in which there is the sanctioned amount that is given by the bank. In this case, NPA is considered, the overdraft or the cash credit accounts, they are considered NPA if the account becomes out of order. Out of order basically means that if for 90 days the outstanding amount stays above the sanction limit, so more than the sanction limit has been given for 90 days, or no money is deposited, or no money is returned for 90 days, or the deposits are insufficient to cover the interest that is charged for the 90 days, then the overdraft or the cash credit account will be considered out of order. Out of order basically means the three conditions: if for 90 days the outstanding amount stays above the sanction limit, if for the 30 days no money is deposited, or if for the 90 days the deposits are insufficient to cover the interest that is charged. In this case, the overdraft or the cash credit accounts, they become NPA. If withdrawals continue for 90 days using stock or receivable statements older than 3 months, then also this will be considered as NPA. Agricultural loans, repayment remains overdue for 2 crop seasons for short duration crops that usually grow in 3 months, and repayment remains overdue if for one crop season for long duration crops. So in the agricultural loans, the NPA is not according to the 90 days. The NPA is according to the crop seasons. Okay, so if the repayment remains overdue for 2 crop seasons for short duration crops, or 1 crop duration for long duration crop, in this case the agricultural loans will be considered NPA, because agricultural loans, in this case the repayment happens after the harvesting, or repayment is possible after the harvesting. Okay, so in this case the crop seasons, through that the NPA is recognized. Securitization transaction, if the loans are converted into the securities that are sold to the investors. Okay, so there are certain loans that are pooled together, like let's say housing loans have been pooled together and they have been converted into securities to be sold in the financial market to the investors. Okay, in this case what happens, that let's say some of the borrowers, they are not paying the interest, so the investors will not receive the interest. Now the bank can provide the liquidity facility the bank can provide the liquidity facility so that the investors, they continue getting the interest, so that the investors do not lose trust on these securities and they do not start selling these securities. Okay, so banks can provide the liquidity facility and can, on from its own account, the bank can pay interest to the investors, thinking that the borrowers will pay after some time. Okay, borrowers are in the stress, they will pay after some time. So this is the liquidity facility amount. If it remains outstanding, that means the interest has been paid by the bank to the investors, but the borrowers are not paying the interest for more than 90 days, then the securitization transaction will be considered NPA. Okay, so if the bank has given the liquidity facility, has provided the liquidity to the investors where the borrowers are not paying regularly, so in this case, if the liquidity facility remains outstanding, that means borrowers have not paid for more than 90 days, then the securitization transaction will also become NPA. Partial credit enhancement, in this case, partial credit enhancement, if the investor is issuing, if the issuer, there is the issuer of the bond, the corporate entity is issuing the bond. Now, the corporate entity, when it issues the bond, when the corporate entity is issuing the bond has, let's say, less credit rating. Not very less, but yes, or let's say the corporate entity, it wants to issue the bond to more investors. Now, the investors are not very sure that should they invest in this bond or not. Now, the corporate entity is getting the partial credit enhancement from the bank. In the partial credit enhancement, what happens, that the corporate entity has got the partial credit enhancement for this bond, that if the corporate entity is unable to pay at a point of time, if the corporate entity is not able to pay the interest for a short duration of time, then the bank will pay the interest to the investors, so that the investors will get continuous money and the investors will not the money will not be delayed for the investors. Okay, now this is known as the partial credit enhancement from the bank. Bank is basically, in the future, if any problems come with the corporate entity, so on the behalf of the corporate entity, the bank will pay the interest to the investors. So this is the partial credit enhancement, that for certain amount, there is the credit enhancement, there is a credit line that is provided to the corporate entity. The corporate entity will have to return the money to the banks within a short duration of time. If the bank has used this partial credit enhancement, that is on behalf of the corporate entity, the bank has paid the interest. The amount has been drawn, the amount has been taken by the corporate entity under the partial credit enhancement facility, and it remains outstanding from the date of drawal for 90 days or more, then this partial credit enhancement will be considered NPA. I hope this is very much clear, that on behalf of the corporate entity, the bank can pay the interest or bank can pay certain amount. Okay, but the corporate entity will have to return the money to the bank, because bank has paid on behalf of the corporate entity, so corporate entity has to return the money in the future within 90 days. If the amount remains outstanding from the date of drawal for 90 days or more, then it will be considered NPA from the end of the bank. Next, credit card accounts, minimum amount due not fully paid remains unpaid for 90 days from the payment due date. Multiple loans to same borrower, in case multiple loans have been given to the same borrower, if one loan or exposure become NPA, all the other exposure to the same borrower will be considered NPA. So NPA classification is applied at the borrower level, not just at the individual loan level. Okay, if one loan of the borrower is becoming NPA, then all the other loans to the same borrower by the bank will be considered NPA. Let's say a borrower has taken the credit card facility, overdraft facility, and a loan. So if this loan is becoming NPA, that means the credit card and the overdraft will also be coming under the category of NPA. Okay, so the NPA is classified at the borrower level, not just at the individual level. Upgradation of NPA accounts, so NPA can be upgraded to standard asset if the entire overdue interest and the principal across all facilities have been repaid. So the NPA, non-performing asset, will only be classified as the standard asset, as the normal asset, when all the payments have been paid. Now, special cases of asset classification as NPA, there are some special cases that we have to discuss. NPA NPI linkage for same issuer. What happens? Let's say that a bank has provided a loan to XYZ corporate entity. The bank has also invested in the debt instrument of the XYZ corporate entity. The bank has also invested in the shares of the XYZ corporate entity. The bank has also invested in the other instruments like the debentures or the derivatives launched by this XYZ corporate entity. So if same borrower or issuer has both loan exposure, so bank has the loan exposure to this borrower as well as the investment exposure to this borrower. If any credit facility of an issuer becomes NPA, that means if the loan is becoming NPA or if the overdraft facility is becoming NPA with the borrower, investment in the securities, debt instrument shares issued by the same issuer shall also become non-performing investment and vice versa. So if a loan is becoming NPA, the investments will be considered non-performing investment. If the investment, let's say debt instrument, has become NPI, non-performing investment, the maturity proceeds are not coming, the amount is not being paid under the debt instrument. So if the investment is becoming NPI, so the loans will be considered NPA for the same borrower. Okay. Exception is if only preference shares become NPI, other performing securities or loans of the same issuer need not become NPI or NPA. So if only preference shares, in the case of preference shares, what happen? In the case of shares, what happen now? That sometimes the banks, like for a quarter or for a year, maybe the bank is not able to get the profit. So the bank may not be able to give the dividends. So if preference shares become NPI, it might be because of the regular reasons the bank is working efficiently, but still the bank is not able to show the profits. Okay. So if only preference shares become NPI, other performing securities or loans will not be considered NPA or NPI. So usually for a borrower, what happens? Let's say this entity XYZ has become NPA on a loan. So all other securities of this borrower that the bank has invested in will be considered NPI, non-performing investment. So if a bank has provided a loan to the XYZ entity which is becoming NPA, so all other loans provided to the same borrower, the facilities provided to the same borrower will be considered NPA and the investment will be considered NPI. If the bank has purchased debt instrument of this XYZ and this debt instrument is becoming non-performing investment, so all the other loans or facilities that the bank has given to the borrower will be considered NPA. But in case of preference shares, this will not happen. If only preference shares are becoming non-performing investment, then the other investments or the other loans will not be considered NPI or NPA. Okay. Now, co-lending arrangement, if there are two lenders jointly giving one loan, if one lender classifies the loan as the special mention account or NPA, the other lender must also give the same classification that this account is under the stress or the account has become NPA. So the same classification has to be given by both the lenders. If one lender has said that the account is under the special mention account under the stress or has become the NPA, the other lender has also to give the same classification immediately, latest by next working day. Loan against fixed term deposits. So if loan are given against the fixed term deposit, let's say that you have a FD of 1 crore and the loan that you have taken is 50 lakh. So now this, even if you are not paying the interest, even if you are not paying the EMIs, even if you are not paying the principal amount, can we say that this loan has become NPA? This is the loan and this is the fixed deposit that is of 1 crore, that is the collateral with the same bank. Can we say that this loan has become NPA according to you? Yes or no? So basically, if the loan is backed by a fixed deposit, it is not considered NPA. So this is the idea. Till when it is not considered the NPA? So loan is backed by a term deposit in the same bank. Okay? Loan need not become NPA. So if the loan is backed by term deposit, if the loan is backed by term deposit in the same bank, any confusion? Is this clear? So if the loan is, no confusion? Okay. So if the loan is backed by a term deposit, that is a fixed deposit in the same bank, the loan need not become the NPA. If the margin, that is the value of term deposit, it is not below 100%, okay, including the interest. So basically, if the loan, including the interest, is, let's say loan is 50 lakh and the uh, interest is around coming 10,000 up to 1 lakh in a year, or up to 5 lakh in a year. But the fixed deposit, the term deposit is still 1 crore. So even after including the interest, the loan is not becoming NPA. This is the idea. Okay. So the loan is backed by the term deposit in the same bank, and loan need not become NPA if the margin, that is the value of the term deposit as a percentage of the loan outstanding, inclusive of the interest, is not below 100%. That means the whole loan outstanding amount as well as the interest is being covered, Now, whenever the NPA is classified, it is not classified at the loan wise manner. It is classified at the borrower level, that the borrower has become NPA. Okay. Government securities. Now, investment in central government securities and the SLR eligible state government securities. So there are the government securities that are kept in under the statutory liquidity ratio, that is the reserves that the banks are maintaining with themselves. Okay. So under the SLR, the banks can keep gold, the banks can keep cash, and the government securities. So the state government securities that are eligible to be kept under the SLR, they will never be classified as NPI, as non-performing investment. So the central government securities and the state government securities that are eligible under the SLR will not be treated as NPI, This exemption applies only for the asset classification, for the NPA classification, that these investments will never be classified as NPI. But for the income recognition, this criteria will not be followed. Let's say under the central government securities, for 1 quarter or for 1 year, there is no interest that is paid, because the interest will be paid combined in the next year. So the bank cannot classify this central government security as NPI, as non-performing investment. Even if the state government securities, they are not paying the interest on, let's say, quarterly basis or half yearly basis, the bank cannot classify these state government securities that are SLR eligible as NPI. But can the bank recognize the profits even when the profits have not been given by the central government securities or the state government securities? So these interest cannot be recognized. Okay. So that's why it has been said very clearly that when we are considering the NPI status, this is only for the NPA classification, for the asset classification. For the income recognition, the central government securities, state government securities, if they are not paying the interest, they should not be the income should not be recognized till the interest is paid. So the bank still cannot treat unpaid interest as earned income unless it is actually received. So this exemption, that the government security, central government securities, SLR eligible state government securities, they will never be treated as NPI. This exemption is only for the asset classification, not for income recognition. That is the mota idea. Now, export project finance. So foreign buyers pays. Let's say the foreign buyer has taken a loan from the State Bank of India foreign branch. Okay. So a foreign borrower has taken a loan from the State Bank of India foreign overseas branch. Now the foreign borrower or the foreign buyer has paid abroad, but money cannot reach India due to war or sanctions or unrest. So the foreign government has blocked the funds to move out of the country. So the funds cannot reach India because of certain restrictions. If the State Bank of India overseas branch can prove that the borrower has already paid before account became NPA, the NPA classification may be postponed for 1 year from the date of deposit in foreign bank. So basically, this is the basic idea, that if the foreign borrower has paid abroad, let's say to a foreign bank only, so that the foreign bank can pay the amount to the State Bank of India. But what has happened, that the money has not reached to the State Bank of India, but the bank, the State Bank of India, if it proves that the borrower has already paid before account became NPA, the NPA classification will be postponed for 1 year. That is the idea. Now, agricultural advances, crop season based NPA classification. So in the case of agriculture, the NPA is on the basis of the crop season. Okay. Now there are certain types of loans covered, borrower category. So this we have to discuss. Okay. Yes. So the crop season based asset classification norm shall be made applicable only to the following credit. So the crop season based NPA classification for the agricultural loans is applicable for such kind of borrower category and such kind of loans. If we are any other loan that is not in these category will have the same 90 days criteria. So this is the idea that the crop season based asset classification norms, they apply to the agricultural term loans that are mentioned below. So borrower category, if the individual farmers are there, self-help groups and joint liability groups directly engaged in agriculture, these groups of individual farmers, if they are provided with the crop loans, including plantation, horticulture, medium and long-term farm loans, loan for pre-harvest or post-harvest activities, loans up to 60 lakh against the pledged agricultural produce not exceeding 12 months. So these kind of loans that you can read, these kind of loans basically will come under the NPA categorization only when the crop season criteria is being met, that is 2 crop seasons for the short term crop and for 1 crop season for the long term crop that has passed, then they will be considered NPA. Loans to corporate farmers, farmer produce organizations, farmer produce companies, partnership farms, if they have taken the loan up to the limit of 4 crore per borrower, then in this case these loans will only be considered NPA on the basis of the crop season. When 2 crop seasons have passed, like the amount is outstanding and the 2 crop seasons have passed for the short duration crops and one crop season has passed for the long duration crop, then these loans only can be classified as NPA. Okay. In case of the loans to primary agricultural credit societies, farmer service societies, large sized Adivasi multipurpose societies, if they are taking the loan from the bank to give the loan further for the agriculture purposes to the individual farmers and such, in this case also the loans will be classified as NPA only when the outstanding amount is like the loan amount is outstanding for 2 crop seasons or 1 crop season on the basis of the duration. Chalo. Agricultural loans that are not covered above categories will follow the normal NPA rule of 90 days, of more than 90 days. Now coming to the last part, that is classification of NPAs based on default period and recovery possibility. So see, the NPA, a loan becomes NPA. We have discussed the different criteria that when a loan is becoming NPA. Agricultural loan is becoming NPA. The agricultural loans, especially these kind of loans, they will become NPA on the basis of the crop season, okay. So agricultural loans, if the repayment remains overdue for 2 crop seasons for short duration crop and the repayment is overdue for 1 crop season for long duration crop, then the agricultural loans will be considered NPA. For the other categories, the loan becoming NPA if the loan is not paid, if the amount is not paid for 90 days or more than that. Okay. So this is the NPA categorization. If the loan is not paid for more than 90 days, then the loan becomes NPA. Now, substandard asset, an asset which has remained NPA. The loan which has remained NPA for a period less than or equal to 12 months. Just a second, huh? Okay, let's continue. Sorry. So if the loan is NPA for if the loan is NPA, if the loan is not paid for 90 days. Yes. So basically, if the payment remains overdue for more than 90 days, the loan becomes NPA. Now, if the asset, that means if the loan which has remained NPA has for a period less than or equal to 12 months, they will be considered substandard asset. So if the loan is under the NPA category for a period up to 12 months, that NPA, that loan will come under substandard asset category. Okay? If the asset which has remained in the substandard category for a period of 12 months. So if an asset, if a NPA basically, non-performing asset has remained in the substandard category for a period of 12 months, so that will come under the doubtful asset. Loss asset is basically the asset where loss has been identified that the money cannot be recovered. So this is the idea that the standard assets, they are the assets where the standard payments are happening, the interest is coming, the EMI is coming, the principal payments are coming, so every payment is happening smooth. The NPA, the payment is overdue for more than 90 days, so the loan will be considered NPA. Now the loan will come under the substandard category if the NPA is for up to 12 months. If the loan is under the NPA category for up to 12 months, it will come under the substandard category. And if the asset is under the substandard asset, if the loan is under the substandard category for 12 months, then the loan will come under the doubtful category. So you can understand that this is the categorization. Now previously what used to happen, that there was the incurred loss formula or the incurred loss model that was being used. Okay, but now we are saying, or the RBI is saying, that you have to move to the expected loss model. In the incurred loss model, the higher provisions had to be maintained after the NPA has been recognized. That means after the loss has been considered, the loss has happened. But in the expected loss model, it is said that higher provisions should be maintained even before recognizing the loan as NPA. Because think about it, that let's say the payment had to happen on 19th of May. If the payment has not happened on 19th of May and for 30 days, the payment has not happened. Now, is it an NPA? Will this loan be considered NPA? Yes or no? Will this loan be considered NPA? No, because only for 30 days the payment has not happened. But this loan will be under stress because the payment has not happened for 30 days. So yes, there might be some stress that is there, because why the payments are not happening regularly? The payment should have happened on 19th of May, but it is 19th of June that has come, but the payment has still not happened. So the bank has already seen that yes, there is stress in the loan, but still the bank is not taking any step, is not maintaining any additional provisions. So in the incurred loss model, the problem was that only when the loss has been recognized, when the loan has become NPA, then only higher provisions have to be maintained. But what about the time period till the 90 days? The loan is overdue. The payment has been not paid for the past 90 days. So why in the past 90 days there was no additional provisions that were maintained? So the expected loss model, the expected loss model says that in the initial period only, we should recognize the stress, we should take steps to handle the stress, and the bank has to maintain higher provision to handle this kind of stress. Got it? Let's see this through the example so that you understand it better. So basically, under the incurred loss model, what was happening, that initially when you have given the loan, then you are maintaining the provisions of 0.25% to approximately 1% or to 5%. Okay, so these were the kind of provisions that were maintained for standard assets. 0.25% of the provisions, 1% of the provisions, or 0.75% of provisions, 0.40% of provisions. For the normal loans, for the standard assets, the provisions were maintained within the range of 0.25% to 1% of provisions. These were the provisions that were maintained against the loans. Okay, these were the provisions that were maintained for the standard assets when the assets are normally functioning, when the payments are coming normally. Now, what happened that as the loan become substandard asset, not NPA, we are talking about the substandard asset. So when the loan has become the substandard asset, that means the loan is under the NPA category for around 12 months. Up to 12 months. Then it has been said that if the loan is entering the substandard asset category, then a general provision of 15% has to be maintained for the secured loan, for the loan portion that is secured by the collateral, and 25% of provisions have to be maintained for the portion of the loan that is unsecured, Now, if the loan has become doubtful, that means 12 months have passed, the NPA has become, there was the NPA and the NPA has been under the substandard asset category for 12 months. That has passed. The NPA has been in substandard asset category for 12 months. So after that, when the NPA has become doubtful asset, or when the loan from the substandard asset is converting into the doubtful asset, for the unsecured portion, then 100% of provisions have to be maintained. So the provisions are increasing from 25% to see the 100% for the unsecured assets. And for the secured assets, or for the loans that are secured through the collateral, up to 1 year under the doubtful category, 25% of provisions, from 15% to 25%, from 15% to 25%. 1 to 3 years, 40%, more than 3 years, see the 100% from the 40%. So it was very, like, the whole system was very complicated to follow, and the provisions were increasing very rapidly. Like in the standard asset category, only the provisions of 0.25% to 1% was being maintained. Again, in the normal scenario. Then as soon as the standard asset is becoming substandard asset, that means NPA is not recognized, like NPA is not seen for the 90 days time period. There were no increase in the provisions. The bank was not stressed at all till the NPA, the loan was becoming NPA. In the initial 90 days, no steps were taken, no provisions were maintained. When the NPA is going in the category of substandard asset, so basically asset which has remained NPA for a period less than or equal to 12 months, that is substandard asset. Okay, so asset, so basically the NPA has come under the category of substandard asset, then the provisions are increasing to 15% in case of secured loan and 25% in case of unsecured portion of the loan. Then when the loan is going in the doubtful category after 12 months, when the loan is going under the doubtful category, then the provisions are increased. In the secured loan, provisions are increased from 15% to 25% to 40%, and directly then 100%. In the unsecured category, from 25% directly to 100% provisions. So can you see that there was, first of all, the provisions are increasing in a very erratic manner. That the banks, in the initial period, the banks are not maintaining much provisions, and then suddenly in just 1 or 2 time period, like 1 year, 60% of additional provisions have to be maintained. In just like 1 to 3 years, 40% of the provision, and after the 3 years, if more than 3 years, just then 100% of provisions. And in the unsecured category, as soon as in 1 year itself, like when the loan is transferring from some standard asset to doubtful asset, from 25%, the provisions are increasing to 100%. So the problem was coming that the initial period, there were no provisions. Till the loan is becoming NPA, there were no provisions that the bank had to maintain, no additional provisions that the bank had to maintain. And after the loan has become substandard asset, and when the loan is becoming doubtful asset, there were very huge increase in the provisions requirement. So it was leading to much distress and problem in the banks, because banks initially do not recognize, they do not want to maintain additional provisions. They would rather use the money to give out loans, to invest somewhere. So in the initial period, they were not maintaining much provisions, and when they had to maintain the 100% of provision, they had to bring a lot of money at one point of time. So this led to some problems. That's why the RBI said that instead of following the incurred loss model, we will follow the expected credit loss based provisioning, so that when the loan has not even become NPA, then also in this time period also, when the loan is like the payment is overdue for 30 days, the payment is overdue for 60 days and such, in this time period also the bank should start maintaining some provisions. Any confusion? So this we will discuss. So basically the loans will be divided into three stages: stage 1, stage 2 and stage 3. Stage 1 is the standard assets. That means these assets, they do not have any significant increase in credit risk. Okay, there is no significant increase in credit risk. So in the case of standard assets, they will be kept under the stage 1. There is no significant increase in credit risk, and for these instruments or loans, bank recognizes the expected credit loss for the next 12 months. So basic provisions will be maintained for the next 12 months. The basic provisions will be maintained within the range of 0.25% to 0.40%. Is the same as the incurred loss model. Stage 1 seems same, right? That is correct. Stage 1 is nearly the same. In the incurred loss model also, for the standard asset, basic provisions were maintained. In the expected loss model also, for the standard assets, basic provisions are maintained. But now comes the stage 2. The loan hasn't officially defaulted yet, but their financial health has noticeably weakened, because for the past 30 days, the payment due is happening, or for the past 60 days there are some payment dues that are happening. So that means in the initial period only, in the starting 30 days only, it is recognized that yes, regardless of the manner in which bank assess the significant increase in the credit risk, there shall be a presumption that the credit risk on a financial instrument has increased significantly. So there is a significant increase in the credit risk if the contractual payments that should have come to the bank, the interest payment, the EMI, the payments that should have come to the bank are more than 30 days past due. So now we are not taking the 90-day criteria to start maintaining the provisions like after the NPA. So now we are not waiting for the loan to become NPA. So now we are not going to wait. We are not going to wait for the loan to become NPA. As soon as it is seen that, okay, for the past 30 days, the payments have been due. That means this loan can become NPA. This loan can become NPA. So as soon as the stage 2 has been reached, that means the financial instrument has, or the loan or the asset has experienced a significant increase in the credit risk, means there are some payment dues since it was first recognized, but it is not yet credit impaired. It has not become NPA, but there are some risk that has been identified. So should the bank start maintaining higher provisions, yes or no? If the risk has been identified, should the bank start maintaining higher provisions? Yes, the bank will start in the stage 2, bank will start maintaining 5% of the provisions. So that means the bank has recognized that yes, loss can happen. There can be loss in the future. Yes, this loan can become NPA in the future. Okay, so bank has recognized this problem, and stage 2 classification shall be applied at the facility level, loan level. And it is considered that in the entire lifetime, bank recognizes expected loss for the entire lifetime of the loan instrument. On the basis of that, 5% of provisions have to be maintained. Now stage 3 is when the NPA has been recognized. So credit impaired assets, that means NPA has been recognized for more than 90 days. Now the loan payments are not coming. So in this case, the loss is considered for the entire lifetime, and the provisions have to be maintained. Now how the provisions have to be maintained? So basically, as I've shown you, that in the initial period when the loan is standard asset, in the stage 1, the provisions are from 0.25% to 0.40%. In the stage 2, when the NPA has not happened, but there are some stress that is identified, that for 30 days the payment is overdue, not for 90 days now, but for 30 days also, the provisions, 5% of provisions have to be maintained. Now, if the loan is NPA, the prudential floor for above loan product categories that have moved into stage 3. Stage 3 basically means that the NPA has been recognized. So as soon as the NPA has been recognized, in the first year, 25% of the secured portion 25% of provisions for the secured portion and 40% of the provisions for the unsecured portion. 1 to 2 years, if in the next year, 40% of provisions for the secured loans and 100% of provisions for the unsecured loan. Then in the third year, for 55% of provisions for the secured loans, fourth year, 75% of provisions, and then 100%. So here you can see that in the incurred loss, there was the increase in the secured loan part. In the secured loan part, the provisions were increasing from 15% to 25% to 40% to 100%. And in the unsecured loan, the provisions were increasing from 25% to 100%. Now, in the expected credit loss, what has happened? In the expected credit loss, the provisions will increase from 0.40% to 5% first, without the loan becoming NPA. Once the loan has become NPA, in the initial first year only, the provisions have to be increased to 25%. In the secured loan, the provisions have to be increased to 25%, and the unsecured, the provisions have to be increased from for unsecured provisions have to be increased to 40%. Then slowly and slowly the provisions have to be increased for the secured portion of the loan, and for unsecured 40% to 100%. So this is the idea. Any confusion till now? Any confusion? So this is the idea that in the expected credit loss framework, the loss has to be identified as soon as there are any fluctuations in the payment, there are any delays in the payment. We do not have to wait for the loan to become NPA to recognize the loss, to start maintaining a higher provisions for the loss. In the expected loss framework, before the loan becoming NPA, before that, as soon as the stress is identified that there are delays in the payments and such, as soon as the stress is identified, higher provisions should be maintained. Okay, so stage 1, that means standard assets. For that, normal provisions that have to be maintained. For stage 2, that means NPA has not been recognized but the stress has been recognized, so higher provisions of 5%. And as soon as the loan becomes the NPA, after the loan has become the NPA, then in the initial year, 25% of the secured 25% provisions for the secured loan, 40% of provisions for the unsecured loan, then 40% of provisions for the secured loan, and 100% of provisions for the unsecured loan. The 100% of provisions for the unsecured loan and for secured loan, provisions will increase slowly so that the bank has some area to increase the provisions, 55%, 75%, and then 100%. Okay, and the confusion about the standard asset to doubtful asset and how the provisions will be maintained, that confusion has been removed by just giving the years. Now, all clear? Any confusion, anyone? So in the previous incurred, now these are the previous percentages that you do not have to remember. This is just to give you the clear idea. But in the incurred loss model, when the NPA was recognized, 15% had to be maintained as provisions, that increased to 25%, 40%, and 100% in the secured loan category. In the unsecured part, the 25% of provisions in the substandard asset, then directly to 100%. Now there is some more area is given for the loans provisions. Okay, for the secured loans, the provisions will increase to 5% for the secured portion of the loan. If it is under stress, so it will come under stage 2, the provisions will be 5%, that will be increased to 25%, then 40%, then 55, 75, and then 100. So there is more area to increase the provisions. There is more time period to increase the provisions, because in the initial period only the loan were recognized as NPA. Okay, any confusion now? And you can see that the same, like up to 1 year, 3 years, more than 3 years, so same time period is nearly same. Okay, NPA is becoming NPA has been recognized, so NPA will become, in the incurred loss model, you can see that the NPA has been recognized. It will be kept under substandard asset for around 12 months. So till then, like for 1 year, there was the provision of 15% for the secured loan and 25% for the unsecured loan. After that, from doubtful category, now the loan has come under the doubtful category after 1 year time period. Then, so again, in this also 1 year plus this more than 3 years, that means 4 years. In the same timeline, the 100% of provisions had to be maintained. Here also, till 4 years, the 100% of provisions have to be maintained. Like after 4 years, the 100% of provisions have to be maintained. But this process is more systematic. It provides more time period for the banks to slowly increase the provisions rather than erratically increasing the provisions. Okay? No confusion? Okay, there are certain additional information that is provided here that we will discuss in the next session. Okay, in the next session, we will revise the whole article and then we will discuss the further part. So we have to, like, the asset classification, the important part is covered. I have shown you the stage wise classification, stage 1, stage 2 and stage 3. Stage 1 is for the standard assets. Basic provisions have to be maintained. Stage 2 is for the loans that are under the stress, and it is considered that this is the lifetime stress, and the provisions, 5% of provisions have to be maintained. And then the stage 3 is for the NPA. As soon as the loan becomes NPA, the lifetime stress is final and the provisions have to be maintained at the higher level. 25% for the unsecured loans, 40% for the 25% for the secured loans, 25% for the secured loan, 40% for the unsecured portion, and that has to be increased slowly for the secured loan, but for the unsecured portion, 40% to 100% directly. So this is the idea. Now, in the next session, I will provide you the questions also. We will discuss the questions and then we will move forward with the rest of the article. But this is it for today. So this is it. Thank you, everyone. Thank you for joining. Now, in the next session, we will complete this topic. So thank you, everyone. I hope the things are clear, and do tell me in the comment section below, like in the common equity tier 1 capital, the quarterly profits will be added. In this, the dividend, the average dividend is taken for how many years? Okay, average dividend is considered for how many years? This is from the first article. From the second article, you can tell me in the comment section that in the stage 2, what are the provisions that have to be maintained? What is the set amount of the provisions that have to be maintained, the percentage of provisions? And in the stage 3, what are the initial provisions that have to be maintained in the 0 to 1 year? In this time period, what are the provisions that have to be maintained for the secured loan and for the unsecured loan? Okay, so this is the idea. So these are the 3 questions that you have to answer in the comment section below. So thank you, everyone. Thank you for joining.